Hey everyone, as I travel around the country participating in various conferences and events, the top question I'm now hearing is whether cap rates will follow interest rates and go lower. The quick answer is maybe. As you can likely guess, there's a wide range of variables that affect cap rates, and yield margin is just one of them. In this video, I'll highlight several of the major considerations placing both upward and downward pressure on cap rates. On a macro level, there's a couple of factors that could put downward pressure on cap rates right now. The lower interest rates and widening yield spread is one of them. In theory, because the cost of capital is lower, buyers can pay a higher price and maintain their yield spread. And generally, this theory has merit, but buyers are also considering recession risk right now, and they're factoring that into their underwriting. The uncertainty that put downward pressure on interest rates is also pushing buyers to be more cautious in their underwriting. Probably a more significant factor is the increased flow of capital into commercial real estate. Transaction activity in the four main property types has been robust and steady. 2019 looks like it'll be the fifth year in a row where transactions total about 55,000 deals, and that's up about 27% from the 2006 peak. This elevated activity implies there's more capital pursuing commercial real estate than ever before. Considering the comparatively attractive yields offered by real estate and the volatility of financial and stock markets, demand for real estate could spark enough competition to put downward pressure on cap rates. Now, on the flip side, traditionally, cap rates and interest rates have not moved in tandem, at least not over the short term. For example, when rates were falling in 2008, cap rates were rising. And in 2013, when interest rates were rising, cap rates were falling. So they're not moving together all the time, at least over a short-term span, although they do move together over the long term. Also, last year, as interest rates went up, cap rates remained stable. Part of that was lenders tightening their spreads, but as rates have come down, lenders have been opening their spreads back up. So this argues that cap rates should remain stable. Now, there's a lot of other considerations. One is property type, as well as the local market outlook. Apartments have been supported by demographics and low unemployment, and they currently have a particularly strong outlook. They may generate more downward pressure on cap rates. Single-tenant net lease properties with their bond-like characteristics may also still face some downward pressure. The downward pressure on industrial cap rates looks like it's beginning to abate, but this is mostly for the large warehouse facilities. Infill industrial is still very much in demand. Office cap rates have generally been stable, but there's considerable variance on a market-by-market basis. Of course, the local markets also matter. What's happening in the local economy, with the local population trends, legislation, and construction can all have an impact on the performance outlook and cap rates in the local area. For example, rent control in California, New York, and Oregon could put upward pressure on apartment cap rates. In WrapUp, there's numerous factors influencing cap rates beyond the movement of interest rates. The widened spread does offer a unique opportunity for investors to lock in low rates on their loans. So barring a significant economic or geopolitical setback this year, the second half of 2019 looks pretty solid for investors.